Hello and welcome to another webinar on forecasting. This one we're talking about mastering tax strategies. So no more surprises using forecasting. We're going to go to the next slide here. So today's session is designed to help you gain control and confidence in your financial decisions. First, we'll talk about the storm. We'll discuss why so many businesses face tax bills each year and how forecasting can help prevent them by bringing visibility and structure to your forecast. Second, the forecast. We'll show you how using these helpful insights will help you move from a reactive decision-making to a confident strategic growth. And then by the end of today, we'll show you exactly how to connect your forecasting process with your tax planning so you can stay ahead of the storm and invest those tax savings into growing your business. So, the surprise tax storm. Now, it's no surprise that we have a tax storm every single year, but the way we prepare it changes from year to year. Some of the common reasons why we're not prepared for this tax storm that we know is going to happen is the fear of confronting financial realities, right? Sometimes people just don't like to look at the numbers, and that's okay, but you really have to face the storm head on. The other major factor is incomplete or outdated financial information. This really hits home, and we really see a lot of clients that struggle with getting their books up in order, being able to look at financial information and make decisions. So we really try at Porte Brown to help you master that piece of getting the books up to date. And then the other piece is minimal or no proactive tax planning strategy at all. So they might have a strong bookkeeper or even someone internally that they do to close the books, but they don't have that know-how to do that, to do the tax planning. And they kind of just wait until the end of the year, once the year is over, to address the storm. When we forecast, we proactively can see the storm coming and plan for when it hits. This is something where forecasting brings the calm of the storm. So forecasting is like your radar system. It lets you see what is ahead. With accurate forecasts, you can project your taxable income months in advance, plan for cash needs, and make informed decisions before it's too late to act. Tax strategy and forecasting work hand in hand. Forecasting predicts how strong the storm will be, calculating your taxable income, and clarifying your cash position, and tax planning helps you manage and minimize its impact. Our goal is always to maximize owner compensation and minimize tax liability. By combining these financial results with tax strategy, you're able to stay in control no matter how strong the storm is. And you're able to make proactive decisions with confidence. So we're going to jump into our first poll here. Ideally, when would you like visibility into your tax liability? So if you could answer that quick question for us. As a reminder, this is the second forecasting webinar that we have done. If you haven't been in our first forecasting webinar that kind of talks to you about the basics of forecasting and the benefits, you can go onto our website at portebrown.com. It's under the Resource Center under Webinars. There you can go and check to see all of our other webinars, but specifically the first webinar in this forecasting series. So I'm going to wait a little bit longer to see those results. Okay, I think we have a good amount of people submitting, so we're just going to jump and see the results. So as of no surprise, no one wants to understand their tax liability during tax season. At that point, it's already too late for you to take almost any action to reduce your tax liability, if any. The majority of people said they want to know ongoing, so that's really good. That's part of the forecasting process, is ongoing understanding of what your tax liability is. The other majority of people said, they wanted to know at the end of the year, which is okay too, to figure out and take some proactive steps. And then other people wanted to know quarterly. So I would say quarterly and ongoing are all good things of being proactive and trying to make decisions and trying to maximize your tax strategy. So we're going to go into the next slide here, really talking about how Porte Brown really helps our clients and how we plan in our tax strategy. So we're always very proactive with our clients, trying to meet with them following Q3. So typically October, November is when we're working with our clients on tax planning. And our goal is always to maximize owner compensation and minimize tax liability. And so what does that mean for maximizing owner's compensation, right? We want to maximize their contributions to retirement accounts. That's something that is often missed, especially with the new tax law that's come out, being able to maximize and do the catch-up contributions as needed. So those things change from year to year. We want to make sure that you're maximizing those contributions. The other big thing is balancing between salary and distributions. Oftentimes, a lot of times when we get our clients in to the Porte system, we look and we see their salary. And oftentimes, these clients believe that the only way for them to receive money from the business is through a high salary. Sometimes the high salary is not necessarily needed, so we try to balance between salaries and distributions in order for it to be tax effective, so you can take that money out from the business. And then the biggest thing that we always try to do is minimize tax liability, right? We can do that several different ways. One of the big ways that we can do is plan capital expenditures to support future growth. So this includes equipment, vehicles, etc. For that, the other thing that we can do to minimize some tax liability is planning ahead and doing the tax liability, do the tax planning to reduce any tax penalties and interest. If we're not paying throughout the year, when we know we have taxable income, you're most likely going to get tax penalties and interest for underpayment penalties. So, and then the big one that's out there is always capturing all eligible tax credits, which often take a lot of work for you to claim. There's additional work. It's very different than a deduction. We'll talk a little bit more about how forecasting can help you claim some taxable credits. But in a nutshell, that's Porte Brown's tax strategy to help our clients maximize owner's compensation, minimize tax liability. So how can we do that with forecasting? So forecasting kind of brings your financial picture to life. At Porte Brown, we use what we call a three-way forecast, which combines your profit and loss, cash flow, and balance sheet. This gives you a full view of where your business is heading. This process shows you what's coming over the next 90 days and really helps you make decisions early. We'll know exactly when to expect major cash inflows or outflows, how much cash to hold for an estimated tax payments or distributions, and when it would be ideal to reinvest or cut back as necessary. So how is this done? As I said, we've done a previous webinar. You can go look into that for a little bit more detail. But the major overview of what the forecasting process is you would review your financial position at the end of the month once your books are closed. That's the key to this piece here, is making sure the books are closed. We would then focus on forecasting the next 3 months of performance, which is 90 days. That's 3 months to get you an idea of the next 3 months and how we can adjust any expenditures or anything else that needs to be adjusted based on increases or decreases of revenue. And then we adjust the forecast accordingly and adjust our expectations of what can be taken out of the business, whether it be distributions or if we need to invest in other capital expenditures. So doing this review process then turns your financial review into a continuous feedback loop, and you're not scrambling from year to year of trying to figure out where's my cash going to be at the end of the year, or what's my cash going to be in the quarter or the month when these payments are coming. And so you're able to take a step back and take a more proactive approach in making decisions and being more flexible. The closer that you are to some of these deadlines and some of these payments, the less flexibility that you have to reducing these payments. So the key benefits down here, we were able to project the taxable income, so we know how much how much income we can pay on our tax, how much income would be taxable. We clarify how much cash we have to pay any taxes or distributions. And then, like I said, we can plan for any large upcoming cash inflows or outflows based off the forecast. Financial forecasting. So this piece is in addition to the previous the previous slide here, right? Early detection, clear direction. So that's just building on there. By reviewing your numbers quarterly or even monthly, you can detect shifts in revenue or expenses before they create problems. This early detection, moving your planning from October to July. So typically we're planning, doing some tax planning in October, but allowing to do forecasting at the end of June, early July, because your Q2 would be closed. You would be able to do your forecast for Q3 and you would know 75% of the year. And then it would go into you planning October, November, and December at this time. So we're moving up the discussions of some of this tax planning earlier in the year so you have more visibility and more proactive decisions that you can make before the end of the year, right? So the clear direction allows us to adjust Q3 and Q4 estimates to be paid in, as well as timing capital purchases strategically, and then optimizing distributions. So clients who create regular forecasts are better prepared for capital purchases. These are often large investments that often take months to finalize and represent a significant cash outflow. Failing to place these assets into service by the end of the year can defer tens of hundreds of thousands of dollars in potential tax savings into the following year. So we've seen since COVID, a lot of equipment have large lead times in purchasing. When we get closer to the end of the year. So if you try to buy specific industry equipment, it may take you several months, and by the time that you make some of these decisions, you might not actually receive the equipment in time to actually make the payment and actually take it in hand in order for you to take the deduction. So forecasting allows you to plan in advance when you're going to be deploying this cash, and allows you to, in advance, place orders for these specialized equipment that can take months due to long lead times from vendors. Forecasting is not just a financial exercise, it's one of the most valuable conversations you can have with your advisor. So being proactive creates the greatest value in financial and tax outcomes. Tax planning is probably the most valuable meeting that you have with your Porte Brown advisor every year, trying to minimize that tax liability and try to maximize your owner compensation. Regularly forecasting throughout the year functions as ongoing tax planning, keeping you prepared and informed, as well as assisting in identifying potential tax credits. And the biggest one is cash and tax impact of the transactions prior to execution. So typically when I'm talking with our clients and I'm doing this forecasting process, what's going on is we are looking at the balance sheet, the profit and loss, and the cash flow. And when they have a question of, hey, I want to buy a new piece of equipment, we can generate the revenue for that new piece of equipment, what that piece of equipment is going to bring in. We can plan out the cash outlay for either the loan on the equipment or the money that is needed to purchase the equipment. And then the other piece of it is that we're able to see the tax impact with putting that depreciation in there. So with the forecasting, we're able to see all forms of what is the impact of a single transaction versus having the conversation after the transaction happens, or if the transaction didn't happen at all and it happens into the next year, the things that we could have done to actually improve the tax liability. So one of the other big things here is uncovering tax credits. A tax credit is directly reduces your tax bill dollar for dollar, while a deduction lowers your taxable income. So claiming tax credits often requires maintaining detailed documentation, including wages, hours worked, and related expenses. And often these are needed to be used in order to support the credit that's being taken. So forecasting helps you identify qualifying activities and expenses early through the process by unlocking opportunities to valuable tax credits and R&D. So when I'm meeting with our clients on forecasting and they're saying, hey, I'm working on developing a new service line and we're spending all this money researching and developing this new service line, typically that conversation might not be had until the end of the year if I do my normal tax planning with a client. And by that time, there's amount of work that needs to be done in order to claim these R&D credits. So having these forecasting meetings really helps with identifying different opportunities to take tax credits like R&D. If you're not able to support these expenses or credits for, say, R&D, then you're not able to take these credits at all. So it's important that it comes to the surface, you have those discussions, and you're able to do the work, the legwork, in order to prove the work for these credits such as R&D. We're going to go into our final polling question here. How would you invest your tax savings back into your business? So we're going to wait for that to come through. As another reminder, we do have a webinar from July about the new One Big Beautiful Bill Act that is on our Porte Brown website. Once again, you could view all of our webinars on the Porte Brown website under Resource Center webinars, and you can see how there's some different changes with this year's tax law. So I'm going to wait just a little bit more. All right, we have a good swath of people voting. So we're going to look at our results. So to answer this, we had 5% say, I want to hire some new team members. Usually the big ones are always upgrade equipment and increase tax position. Sometimes with this tax savings, it's not always about, necessarily investing right away into something new to grow the business. A lot of the times, business owners just want to have that ability to breathe, and that's why I'm not surprised where increased cash position is second behind upgrade equipment, is because oftentimes having cash is the ability to make better decisions, right? That proverbial cash is king, and the more that you have of it, the more agile you are to make better decisions, and you feel less pinched in making some of these tax payments. It goes from, hey, everything is an emergency to everything is just a little bump in the road, and then you're able to kind of weather the big storm that kind of goes through year to year. So good to see there. So I kind of just want to wrap everything up. So let's bring everything together. Forecasting gives you the visibility of the size of the storm. It replaces stress and surprise with proactive control. When you see potential issues months ahead, you have time to adjust and not react. Forecasting and tax strategy work together to help you keep more of what you earn. When you align the two, you can time capital purchases, plan distributions, and maximize deductions while minimizing tax liability. This results in a smoother tax season and more consistent cash flow. Forecasting builds confidence and opportunity. It gives you the power to make growth decisions with clarity instead of waiting to see how your year ends. You can reinvest profits strategically, whether that means upgrading equipment, hiring staff, or building reserves for the next opportunity. Together, these three takeaways position you to stay ahead of any financial storm and make forecasting a regular part of your business. So thanks for joining today. We do have another webinar for the year in December. So join us for our final webinar in our three-part series on December 4th, where we'll focus on planning for the year ahead through effective budgeting. So we'll cover proven methods, best practices, and common pitfalls to avoid as you align your budget with your business strategy before the beginning of the year, before the new year. The link is in the related content tab, and it will also be sent to you with a follow-up email that you'll be able to receive from Porte Brown. So with that, I'm going to go to Q&A. So if you have any questions, feel free to put some questions in the chat and I will answer them. If I do not answer your question on the webinar, I will be responding to you via email. So one of the questions I received was, how does forecasting help me decide when to take owner distributions or adjust my salary? So one of the big things forecasting does is it helps you, project your taxable income and cash needs. So at the beginning of the forecasting process would be to look at the owner's salary, maybe the owner's spouse's salary, and say, does this make sense based on current cash flow demands and requirements? And if it does, then we say, okay, salaries are good. Then it's really a discussion about owner distributions and looking to see when we can take them. Typically, when I see clients taking owner distributions, it's for a big life event, say as a vacation, or someone in the family is getting married. Different major life events that happen is when I typically see owner distributions, or some clients like to just, hey, I want to be able to take X amount of dollars each month. How am I able to do that based on the cash flow? So we're able to map those out in advance and kind of get an idea of whether this would be sustainable. Distribution shouldn't strain the business. It should just be kind of taking the proverbial quote unquote cream off the top of the business, and you're being able to take those. So forecasting allows us to map those out and look at the owner distributions to see if it makes sense based on the current cash flow of the business. So that was a great question. I have another question here. You mentioned three-way forecasting. What does that include and why does it matter in tax strategy? So the three-way forecasting includes your profit and loss, your cash flow, and your balance sheet. Together, these three all kind of give you a complete picture of your business performance. So you can see where cash is coming from, where it's going, and how much you have of it. Typically, what I see a lot of clients doing ad hoc when I first work with them on forecasting is they usually have a backlog of work or a pipeline of sales. That's really just a sales forecast, and I would say that's like 50% of what profit and loss forecasting is, because you're missing your expenses. You have all your revenues of, hey, I expect this job or this project to come in on this month, but you don't really have the expenses allocated against that. You don't know when that sales money is going to come in necessarily. You know when you're going to be doing the work and when you've earned it, but getting the money is a different story. And then you also don't know where your cash position is. So that's why we use a three-way forecast in order to kind of bring the full financial picture together and get an idea of where everything is at. So that's the reason why we use three-way forecasting. Got a couple more questions here. How often should we update our financial forecast to stay on top of tax planning? So ideally, it would be every month. I would say that would be the best approach. Second to that is probably quarterly. Um, if your business is experiencing major cash flow swings, I would say do it. You have to do it monthly, because otherwise, you have a really good month followed by a bad month. You just don't know when to kind of pop your head out and actually kind of grow the business or take distributions, that kind of thing. So, regularly updating your forecast to make sure it's accurate, really helps you plan for the next couple of months and try to weather any potential cash flow storm that you have based on the swings of revenue. Got a couple more questions here. So you mentioned capital expenditure planning. How does this tie into tax strategy? So, capital expenditure planning is basically a fancy word for, buying equipment and vehicles, right? Not all vehicles you're able to fully deduct. So that's one of the things that I've seen clients have problems with. I've had a client called me on New Year's Eve trying to buy 2 trucks for him and his other partner. It wasn't the best of time. It wasn't the best of time. They were trying to get 2 trucks and they called me up and asking if these were deductible. They weren't 100% deductible, so I tried to move them into something that they would be able to. But they were kind of running around town trying to buy 2 vehicles by the end of the year. So that's not the best tax planning on that side, waiting till last minute to try to get some of these purchases made. So that's why we try to have the discussion up front with our clients about some of these purchases and not waiting till last minute to purchase them. All right. Well, once again, thank you so much for attending this webinar. If you have any additional questions, feel free to send me an email and I would be gladly to reach out to you. Thank you.